Standard checking accounts. These are the most common entry points into the American banking system, designed specifically for daily transactions and frequent movement of money. They act as a central hub where your paycheck is usually deposited and from which you pay your monthly bills, either through a debit card, electronic transfers, or traditional paper checks. Because they are built for high-volume use, they typically offer the lowest interest rates, often near zero, but provide the highest level of liquidity, meaning you can access your cash at any moment without penalty. Most banks will waive the monthly maintenance fees if you maintain a certain balance or have a recurring direct deposit set up from your employer. Interest-bearing checking accounts. These accounts provide a middle ground for those who keep a significant amount of money in their primary spending account and want to see a small return on that balance. While they function exactly like a standard account with full debit and check writing privileges, they pay a modest interest rate that typically fluctuates with the market. The trade-off for this perk is often a much higher minimum balance requirement, which, if not met, can trigger monthly fees that outweigh the interest earned. They were originally created to help banks retain wealthier clients who might otherwise move their liquid cash into dedicated savings products. Student checking accounts. Many financial institutions offer these specialized accounts to young adults and college students to help them establish a banking relationship early in life. They are essentially modified versions of the standard account that waive most monthly fees and often have no minimum balance requirements at all. Banks recognize that students typically have limited incomes and are just learning to manage their finances, so these accounts often include educational tools or mobile alerts to help prevent accidental overdrafts. Once the student reaches a certain age or graduates, the account usually converts into a standard retail banking product with a regular fee structure. Rewards checking accounts. This category has become increasingly popular with online banks and credit unions as a way to incentivize frequent account activity. Instead of just holding money, these accounts offer perks like cash back on debit card purchases or exceptionally high interest rates on balances up to a certain limit. To unlock these rewards each month, users usually have to meet specific criteria, such as making a minimum number of debit transactions or opting into paperless statements. They are an excellent fit for disciplined spenders who use their debit card for almost everything and want their everyday banking to provide a tangible financial kickback. Savings accounts. This type of account is intended for holding money you do not plan to spend immediately, acting as a secondary reservoir to your checking account. While they offer higher interest rates than checking accounts, the primary goal is often safety and modest growth rather than wealth generation. For many decades, federal regulations limited the number of convenient withdrawals you could make from these accounts to 6 per month, and while those rules have since been relaxed, many banks still enforce similar limits to encourage long-term holding. They serve as an ideal place for an emergency fund or a small goal, like a vacation or a new piece of furniture. High-yield savings accounts. These operate exactly like a standard savings account, but offer significantly higher interest rates, often provided by online-only banks that save money by not maintaining physical branches. Because these institutions have lower overhead costs, they pass those savings back to the customer in the form of a more competitive annual percentage yield. While you might lose the ability to walk into a local office and speak to a teller, the trade-off is that your money grows at a much faster pace while remaining just as secure through federal insurance. They have become increasingly popular as digital banking technology has made transferring funds between different institutions nearly instantaneous. Kids and teen savings accounts. These are introductory accounts designed for minors, typically requiring a parent or guardian to act as a joint owner until the child reaches adulthood. They serve as a practical educational tool, often featuring simplified mobile apps that allow children to track their chores and savings goals while parents monitor the activity. Many of these accounts offer small interest rates to teach the concept of compound growth and may even provide a debit card with strict spending limits set by the parent. They are a common way for families to save for a child's future while giving the minor a sense of financial independence under a safe, supervised umbrella. Money market accounts. These are a hybrid financial product that blends the features of both checking and savings accounts into a single vehicle. They generally offer higher interest rates than a basic savings account and often come with a debit card or limited check writing privileges, giving you a bit more flexibility in how you access your cash. Historically, they were designed to compete with mutual funds by offering a market-based rate of return while still being protected by the government. The catch is that banks usually require a much higher minimum balance to open or maintain these accounts, making them a better fit for those with a larger amount of idle cash. Certificates of deposit. Often referred to as CDs, these are time-bound deposits where you agree to leave your money with the bank for a fixed period ranging from a few months to several years. In exchange for giving up access to your funds for that duration, the bank pays you a guaranteed interest rate that is usually higher than what you would find in any liquid account. If you decide to withdraw your money before the agreed-upon date, the bank will charge a penalty, which often equals several months of earned interest. This makes them a useful tool for people who have a specific future date for a purchase, such as a house down payment, and want to ensure their principal is protected from market volatility. Individual retirement accounts. Known widely as IRAs, these are tax-advantaged accounts meant specifically for long-term wealth building and retirement security. Unlike a checking account, the money inside an IRA is usually invested in stocks, bonds, or mutual funds, and the government provides significant tax breaks to encourage people to save. In a traditional IRA, your contributions might be tax-deductible now, while in a Roth IRA, you pay taxes up front so that your withdrawals in retirement are completely tax-free. Because these are strictly for retirement, there are often steep tax penalties for taking money out before you reach age 59 and a half, reflecting their purpose as a lifelong financial foundation. Joint accounts. These are bank accounts owned by two or more individuals, most commonly used by married couples, business partners, or elderly parents and their adult children. Every person listed on the account has equal legal access to the funds, meaning any owner can deposit or withdraw money and write checks without needing the permission of the others. While this makes managing shared household expenses much simpler, it also requires a high level of trust, as each person is equally liable for any fees or debt incurred. From a legal standpoint, if one owner passes away, the funds typically transfer directly to the surviving owner, bypassing the lengthy probate process. Custodian accounts. These accounts, often established under laws like the Uniform Transfers to Minors Act, allow an adult to manage assets for a minor until they reach the age of majority. Unlike a joint savings account where the parent has ownership, the assets in a custodian account legally belong to the child, though the adult remains in control of all investment and spending decisions for the child's benefit. They are often used for gifting significant sums of money or stocks to a child while enjoying certain tax benefits on the unearned income. Once the minor reaches the legal age, which varies by state, the account is turned over to them entirely to use as they see fit. Health savings accounts. Commonly referred to as HSAs, these are unique tax-exempt accounts available to individuals who are enrolled in a high-deductible health insurance plan. They allow you to set aside money specifically for medical expenses, such as doctor visits, prescriptions, or dental care, with the added benefit that contributions are tax-deductible and withdrawals for qualified health costs are tax-free. Many people use these as a long-term investment vehicle because the funds roll over every year and can be invested in the stock market to grow over time. After the age of 65, the funds can even be withdrawn for non-medical reasons, making them a powerful secondary retirement tool.